Welcome back to the next episode of TMT with Mike O'Reilly. My guest, Rick Prentiss, who is the head, I want to get this correct, head of Telecommunication Services and Media Equity Research at Raymond James. He also comes from a long line of experience within telecommunication companies, and he's preparing to walk away from the whole field as he prepares more time with his family. Is that right?
It's close, but what I would say is we like to call it TMT, towers, which we're very much known for towers, media, and telecom and satellite services. So it really, a lot of stuff gets wrapped in there, and walking away from the sell side job, but I don't think you've seen the last of me. You know, probably maybe show up on a board somewhere or still involved in the industry, but walking away from the grind of sell side research after 121, it'll be 122 earnings seasons when I retire.
Maybe that would be helpful to start there. Walk us through your kind of career path. It's not exactly the same, or it's maybe a little atypical than the traditional sell-side analyst.
Yeah, I'd say it's pretty atypical. I went to University of Florida. Okay, go Gators. Went to University of Florida, got my electrical engineering degree. Then I was working in outside plant engineering. You might remember when the lead fear affected the industry, and I actually pulled out my 1979 outside plant engineering handbook that I still have from the AT&T Bell system and said, let's look up lead. So I started out in outside plant engineering down in Fort Lauderdale, Florida, and we were the first one to go fiber. In the 80s, we were putting in fiber because we were the growth area, Florida, within Southern Bell at the time. I was going to school at night also to get my MBA, went to University of Miami, got the other one down there, and got my MBA because what I looked at was, engineering is great. I love being an engineer. I still have an engineering mindset, but I knew there was kind of like a ceiling that engineers only get to really move so far. And getting into the finance side of things, understanding how to run a business, the MBA side of it was going to open up new doors. I got married in the summer of 1983, so coming up on 43 years of marriage here this month, next week. Better go get that present. And got my MBA December of 83, which something very interesting happened January 1st, 1984. Divestiture. The baby Bells were born. And they put out a casting call and said, hey, we got a bunch of engineers and accountants. That's all we used to do at the operating company was engineers and accountants. They said, anybody got a business degree, a marketing degree, strategic planning? Anybody know how to run models? And so I moved up with my wife up to Atlanta and helped birth Bell South in the summer of 84, and then just moved on from there.
Did the nuts and bolts of working for the company, has it really helped on the analyst side of the equation? That's something most don't have.
I think it has helped. I mean, certainly use your skills, use your background. So whatever you have, whatever skills you have, use them to the utmost. And so I use mine, I think, to the utmost, where we're able to explain to people, like one of the things I did at Bell South, beside engineering, finance, mergers and acquisitions, international startups, lived and worked in Germany, came back to be director of IR at Bell South, was I had built these networks, I had financed these networks, I had explained to external partners all over the world, Latin America, Europe, was supposed to go down to Optus in Australia, but then I went to Germany instead. Explained to them what the future of wireless meant as we were going through the 80s and the 90s and just the boom era of what we thought was going to change the world. And it has. So having that experience of having built networks, I think really did help. And like I said, pulling out that outside plant book from 1979 to go, I don't think this lead thing is as big an issue as some of our competitors were making it seem to be. And of course, nobody talks about the issue anymore. It's gone.
Yeah. On the sell side of the equation, help me understand, how many companies do you follow at any given time? You have a portfolio, a bucket of companies. How does that work?
Sure, yeah. So when I left Bell South, summer of 1996, so I've been at Raymond James just over 30 years. We left after the Olympics. We're in Atlanta in 96, and I should have worn my hat. We're having the Olympics here in Utah in 2034, so we're excited for the Olympics here. But I came to Raymond James from Bell South and said, I believe the future of telecom is going to be wireless. And so I came in and I picked up a bunch of wireless stocks. And one thing, those of you out there that have the gray hair like I have, Aerial, OmniPoint, PowerTel, VoiceStream. I got to know John Stanton very well. I got to know everybody in the industry. And of course, John and Brad Horowitz rolled that up to form what is now T-Mobile. And so one thing that I found in my career was get to the hot area, grow it as you can, but understand M&A is going to occur. I looked back, and in the 30 years I've been at Raymond James, my team and I have covered over 75 names because they keep getting bought or getting bigger or going private. And so, yeah, so any given time, I've had probably 16 to 24 names, and we're constantly opening up new veins to mine those and to create advantage.
What does that entail? You talked about earning seasons. What does the role require on a monthly basis, for instance?
Sure, it's an interesting role for those out there that might be interested in the equity research role. I explain it to college kids getting ready to come out of their undergrad or their grad school and say it's really one of the most weird skill sets ever to be on the sell side. One, as you pointed out, it's kind of good to know your industry or technology. It's good to have some background, whether you're a healthcare analyst or a telecom analyst or a banking analyst or biotech analyst. It's good to have that background in your industry, almost like as if you were going to become a COO of a company. Like you know your operations really well. But you also have to be a CFO. You have to be able to do the model. Like we spend a lot of time laying out models as far as what the companies are going to look like over the next 3 years. And in our industry, it's capital intensive industry, you got to have really the ability to say not just what's going on with revenues and expenses, but the balance sheet, how much debt are you going to incur, how much CapEx are you going to spend. Hopefully you get to that free cash flow day when you're producing free cash flow, which is the old hockey stick that we used to talk about on a lot of the industries we follow. So you almost have to be a CFO as well to say, I understand this company, I understand where its revenues, financials, EPS, free cash flow are going, but then you also have to be able to sell it. You have to be persuasive. You have to be able to write pretty good headlines. We try and write some fun headlines. You have to write succinctly in your research notes and your briefs what you're talking about and what your belief is and what your thesis is. And then you have to go out marketing it. You have to go out and convince investors, here's why I think you should buy this stock and not that stock. Or here's why I think this stock is worth this much money. So it's kind of a weird one where you have to be a COO, a CFO, and a CMO kind of all wrapped up into one, which is a very weird skill set because most times the Venn diagram doesn't overlap quite that well.
On the data analysis side of the equation, of your many roles, are you able to get a better picture of a company that you follow than the average public? You're listening to the quarterly calls. You're talking to management, I suspect. Are they telling you things that they're not able to share in the public, or are they obligated to share that?
Sure.
How do you glean off what they're able to say?
So there's a couple of nuggets in there. One is I never want to find out anything that's material, non-public information. That's a no-no. That is bad. I don't want any company executive or individual to share anything like that with me. But there's a mosaic theory too that says not everything is material. Not everything has to have an 8K or something released on it. And there's a way to build by talking with people, talking with private companies that are not ruled by the same kind of material, non-public information disclosure rules that are out there. You talk with people that are in adjacent industries, people that have retired from the industry. So you talk to a wide group of people to try and understand what really is happening here, but you don't want any material non-public information. So there's no way I expect a company's going to tell us something that they haven't shared somewhere else. We also sometimes will focus on, let's look out 3 or 5 years. A lot can happen in the next 1 quarter, 1 year. But if we start moving the goalposts out and saying, where do we think this industry is going to be in the next 3 to 5 years and what's happening to kind of get us to that spot, that can help with that as well.
You talked about the sell side and being a marketing aspect to the role. What does your typical client look like? Is it are you talking to company creditors? Are you talking to folks that are high-end purchasers of stock? Who are the typical clients for your good work?
Right. So with Raymond James, we've got a large retail branch as well. The retail brokers at Raymond James get our research. We have thousands and thousands and thousands of retail brokers at Raymond James. It's a very successful channel for us. We spend time with them, but usually we'll try and have a liaison shop get the research out to them, and they can forward questions in also. Most of our time would be spent on the institutional side instead of the retail side. So the institutional side is where you might send your 401k money, the Fidelities, the Capital, the T. Rowe Prices, Vanguard, others out there, that there's a lot of large companies that manage people's money and that have portfolio managers and analyst levels. Credit as well. Mentioned earlier, we're in a capital intensive industry in the TMT space. Even the tower companies who make a lot of money, print a lot of money, they run typically 5-6 times net debt to EBITDA leverage. That's a lot of debt. A lot of other industries don't carry that magnitude of debt. So we do talk to the credit world as well, because they want to know what's happening with these companies. Also, how good is that credit? How risky is that credit? What's going to happen with that? So we talk to the equity side, the debt side, we'll talk to the private side, because sometimes the privates want to come out and come public as well at some point, or there's transactions.
Are you able to, maybe perhaps read other analysts' work at other shops to know what they're doing, or hear of that they're making interesting claims and you have to then respond to them? Or is that part of the role in some capacity?
Yes and no. I've made it a rule for me and my team. We don't want to read other people's research. I kind of want to be pure. I don't want to get biased. I want really to say, here's what we believe, here's why we believe it, here's what we think you should do with that. Now, of course, we'll hear sometimes, so-and-so is making a call about X. And we might say, well, tell me a little more, because maybe I'll disagree with that. But I don't want to read other people's research, because it really, I think, creates a bias. And I'd rather, it's kind of like reverse plagiarism. I almost feel like if I read something, is it going to somehow seep in also? Whereas I want my research to be a lot more pure.
That's fair. I'm interested in, you've had a long career, 30 years at Raymond James. I'm interested in hearing what were the ones that you got right that maybe everyone else got wrong, or that just really worked for your sector?
Sure. I mean, luckily, and to have a 30-year career on Wall Street, you can put it in dog years, right? I mean, 30 years at the same firm at Wall Street is pretty much unheard of, except at Raymond James. We've got a couple of guys like me that have been here for a long time. The culture is really good at Raymond James. But, when you think about it, I thought aerial omnipoint PowerTel voice stream was a great call. We did our maps. I'm going to give a little hats off. When I left Bell South, I had two things I wanted to try and achieve. I said, DLJ, I had a lot of respect for DLJ. Tim Weller, Denny, they were really good analysts. They had the Dick Tracy report. You probably remember the Dick Tracy report. When I left Bell South in '96, I said, I want to become known as the go-to shop that Raymond James, Rick Prentiss and his team, or who you want to go talk to about wireless, then became towers, then became satellites, then became media. I want them to come to us. Like in the industry, we always really liked the DLJ. And we had done our mapping software and our spectrum charts. And I actually got one from somebody who retired at Sprint recently, and she sent me one of the wall charts that we would do. And it would say, well, here's what Singular, remember them, and here's what AT&T Wireless, and here's what Nextwave. It was like these things were helping people visualize what was going to happen in the industry as far as mergers, as far as combinations. One that I didn't get wrong but took a long time was US Cellular. We thought they were a natural layup, that they were going to get bought. We thought originally Alltel or Verizon, CDMA operator to CDMA operator. Then we thought, well, maybe it's going to move somewhere else. And it took a long time to get that one. But it finally worked. Those stocks have started working. The one that I'd say really we made our mark was the tower companies. That the tower companies were known as one of the people that helped kind of birth the tower industry on the Wall Street side. And I looked at that tower industry and I said, this is probably the best business I've ever seen. BBE, best business ever. Because I'm like, you don't have to build it and hope they come. You build fiber, you spend a lot of money for all your homes pass and your service addresses. And you look at wireless and you say, it's more success-based, but I still have to spend a lot of money to build that free cash flow. The tower industry was EBITDA positive day one and printed money in a competitive moat. the zoning pressure and the fact that you went from 25 miles to 10 miles to 5 miles to 1 mile to a half mile, the competitive structures that are in your circle and your search ring kept shrinking and shrinking. I'm like, wow, to find a business that's related to the health and future success of wireless, has a competitive moat, and is very profitable, that was a great one. I was there at the birth, the boom, the bust. So you might say, Rick, when we're having this interview, what if we'd had this conversation back years ago when the bust happened? What happened to the tower stocks? Well, they overpaid for acquisitions. Got to watch that with almost any sector. They overpaid, they overlevered. They took on too much debt. It was a great business, but 5, 6, maybe 7 times leverage, net debt to EBITDA is the right thing to do there. You have such good credit quality with AT&T, Verizon, and T-Mobile, but some of them, to pursue deals that were costing more and more multiples of EBITDA or free cash flow or tower cash flow, they were starting to get leverage up into the high single digit, double digit, teens, and higher. Now, we do understand that some of the private tower guys out there right now are doing 50% loan to value. And so if you have a US portfolio that might be worth 25 or 30 times, maybe you're putting 12, 13 net debt to EBITDA on that portfolio as a private company. But as a public company, that's way too levered. I can't afford that extra risk. Whereas a private company has a 5, 7, 10, 20 infinite horizon. Public stocks, I mean, I've got guys that rent stocks, right? I've got folks that say, I'm owning this stock not for the next 5 years or the next 2 years or the next year or the next quarter. Sometimes it's I'm owning this for the next week or day. So it's like you have much more shorthand. So the tower stocks got beat up. And I can remember, rest his soul, Steve Dodge was a great guy, American Tower. I was on the road with Steve Dodge, and Jim Takelet had just come in to be the new COO of American Tower. And we were in San Francisco. And I remember investors saying, you know, we're on both sides of the balance sheet, debt and equity. Why don't you bankrupt the equity, protect the debt, and come back out of bankruptcy? And Steve Dodge looked at the guy in the eye and goes, I don't need to do that. I am not going to do that. I don't have to do that. What I should do is, and we echoed this, stop buying stuff. And you can de-lever very quickly. And so the tower stocks, a lot of people on the street made their careers on buying tower stocks in the single digit or double digit that are now worth $75, $175, $200 a share. You find those moments in time when the market's got something really wrong on a fundamentally very strong business that can be fixed. So the towers are probably one of the better calls, but we've had a lot of them.
Are there market moving moments?
Oh, give me the one about what was your bad one.
Well, you mentioned one, but I'm interested here. What's the call that you made that really, that still haunts you?
Yeah, so the one that haunts me, Nextel International. We were picking up a lot of affiliates, right? So we had the Sprint affiliates, the AT&T affiliates, we had Nextel partners as well. We picked up Nextel International. And I have a firm belief that spectrum is very valuable, that you follow the spectrum. And spectrum has value. What I got wrong was saying spectrum has value, but at what point in time? Like, when's the market open up? When's the ability to sell it? What's the supply and demand dynamics? What's the issue of could you sell the spectrum to protect your downside case there? And Nextel International, the timeline took longer to get to where they could sell the spectrum. I think they ended up getting pretty close to what I thought Nextel Brazil was worth and what Nextel Mexico was worth, but it was late. And so you have to understand the market dynamics in the short term. So towers, we followed it, and then we said, no, this thing's going to take off, and it did. The roll-up of wireless, it really did. But the one that haunts me really is Nextel International. The burn on the hand, where we got that one wrong, was really a timing thing. Spectrum has value. Follow the spectrum, but understand it might not have value in the next month, the next quarter, the next year. It might be longer term for a public company in particular.
So are there market-moving moments that are unrelated to communications or even particular companies that wind up influencing the value of stock, that you make a call on a stock and say buy or sell, and then something happens in the geopolitical sphere that throws everything off? Maybe just the timing of it changes the timing you speak of, or it changes demand for those services? When does your call all of a sudden look dated because something happened in the war in Iraq or the housing crisis or something else?
Sure, yeah. Back to towers for a second. One of the things about towers is they're owned by a large group of people. They're real estate, but they're not owned by just real estate investors. Most real estate, besides data centers and towers, are owned by real estate investors. Towers also have TMT investors in it, telecom, media, tech investors in it. You have generalists, you have income investors because they pay a nice dividend in the tower stocks. One thing about the tower stocks is they have a very heavy inverse relationship, inverse correlation with interest rates. I think it's probably more than it should be inverse correlated, but it's real. And so what we've noticed is Trump coming back into office, interest rates have been very volatile. The war in Iran, interest rates any given day, up or down, the pressure that was on Chairman Powell to can you cut rates? It's like, so interest rates, almost nobody can control that, right? I mean, interest rates are meant to help the economy and monitor how hot or how cold and say, I'm trying to manage a macroeconomic US and global process that interest rates can catch you off guard. So when March came around and we invaded and had the war with Iran, it led to a lot of volatility in interest rates, and that hits tower stocks, but it hits all of them. We covered Disney too, right? So we're on the media side, and we've been positive on Disney, neutral on Disney, positive on Disney, neutral. We're back positive again because we look at valuation and we look at historical valuations and we go, this is a good entry point. You have a good safety barrier underneath you if you buy in at this kind of price point, price to earnings or EV to EBITDA. But for Disney, it really is, a lot of the stock movement is going to be on how good is attendance at the parks. And we were worried going into this second quarter earnings, June quarter, they're on a different fiscal year, Disney did okay. They actually had attendance in the parks go up 3% domestically, which we were worried it would be flat. We were worried about gas prices filling up at the pump. We were worried about, can you afford to take these vacations? It's not a cheap vacation. We were worried about Canadians. A lot of Canadians aren't coming down here right now to the US. There's friction there, a lot of friction there. And so but it worked out. We had to buy on it because we said, hey, Disney at this price point, you're going to be okay. And they had a good quarter. So the economy, wars, interest rates, housing crisis, they all affect you. And I don't know the number. There's people smarter than me, a lot of people smarter than me. But when you look at any individual stock, what you have to start with is the macro market's going to have a certain impact on your stock market. And then you're going to have your geopolitical, are you a US stock? And then it's going to be, what industry are you in? Then it's going to be, what company are you? So the company-specific stuff is pretty far down the stack when you consider what else could affect your stock prices out there. So you have to be mindful of what goes on out there.
So the telecom sector as a whole, or maybe certain sectors within, have taken a beating over the last many years, to be generous. And I know, multiple companies will complain that their stock is not valued how it should be. They're not properly equating to all of the assets that they hold and the services they're able. Is there some truth to that? And then how does that change? And it's certainly not as compared to the big tech companies who are still the darling of Wall Street. How does that change? Or does it ever?
It can. It should. It probably will. When you look at the market, there's value investors, there's growth investors, there's income investors, but the market a lot of times values growth. Like, what are you growing? I'm going to give you a better multiple for growing faster, because if I'm saying what's your value this year, if you're growing significantly, 27 and 28, those base numbers are quite a bit higher. We did downgrade T-Mobile, I think it was October going on almost 3 years ago, at $234 a share, saying we had a buy ranking on T-Mobile almost forever. Even before it was T-Mobile, it was Aerial, OmniPoint, PowerTel, VoiceStream. And we liked what they had. We liked that growth that they had. We liked that maverick that they had. But then all of a sudden, it started getting to be, how much more growth is there within wireless? Fixed wireless was good. How much more growth is there? We're excited and hopeful for 5G going to 6G. We had fixed wireless kind of help us in 5G, and you and I have chatted sometimes in Washington. People are like, what else you got for me? We fought hard. You were Mr. Spectrum, man. You got us a lot of spectrum, thankfully. But people in Washington and other departments out there going, what do you have to show for all that spectrum you got? So I'm very hopeful that 6G and the rest of 5G decade of 6G is going to bring us some exciting things. Drones, robotics, wearables, AI, inference, uplink as well as downlink. So I'm very excited there's more coming. But right now, what's your growth profile? And I'm going to pay a higher multiple for a growth company. So when you think of technology companies, they usually are darlings because they got better growth. I've been involved in both, right? I was there at the birth of basically as PCS operators were coming out. We went from 2 operators in the United States, added 6 more licenses, so we had our all 8 table. We're like, God, please don't let there be 8 operators because this needs to be an oligopoly. You can't, 2's not good from a regulatory standpoint. You don't want a monopoly or a duopoly. 6, 7, 8's not good because it's a capital intensive industry. You're not going to earn your return on capital. So naturally, the wireless world should hone down globally to an oligopolistic structure. I want 3, 4, or 5, and it's kind of 3/4s. And so that can give you good growth, but T-Mobile had better growth. They had better multiple. Now they've come down, right? So it's kind of like re-rating. The question with SpaceX is kind of in the background of your question, maybe a little bit there too. This has been a really tough summer into the fall because there was such uncertainty of what could SpaceX actually do from space in regards to wireless. And a lot of us were precluded from talking about it for a long period of time. I think it was July 7th we could finally start talking and writing about it again. Our belief for a very long time, I'm a big believer in the laws of physics. I'm a big believer that you can try and improve things, but you can't break the laws of physics. And you find ways that you can become better operators. But personally, for direct to cell, making your cell phone work from a satellite, I think that's best case is going to be in rural America or rural anywhere. There's more areas without fiber and without wireless in the rest of the world. We go much deeper. I always look at the GDP per capita and population density to figure out what's the right network to build. And that differs between the US, Europe, LATAM, Africa, Asia Pacific as well. So we think satellites have a place within direct to cell is it's a complement in rural America. If you have broader aspirations, you need to do something else. But that called into question the generalist community and the income investors throughout the spring into the summer were like, they can do anything they want from space. We don't believe that. We think they need terrestrial if you really want to offer a robust wireless business. We also separate it between fixed and mobile. That mobile's hard. Space is hard too, but mobile's hard. Fixed is probably a little easier. You can put a dish outside the house and you're not moving around. You don't have roaming. You don't have handoff. You don't have to worry about a lot of that stuff. So from a Wall Street perspective, the cable companies have been under pressure. The telcos have been under pressure. The tower companies have been under pressure because there's this uncertainty. Wall Street also hates uncertainty. So there's this uncertainty of what does the competitive dynamic look like? What does the growth profile look like? And what we've said is we believe it's not a shrinking slice of a pie, it's an expanding pie. Because I like to talk about direct to device as something being different than direct to cell. Direct to device is, okay, I got a watch, I got wearables, I got drones, I got robotics, I got autonomous vehicles, I have cyber air taxis. The future, whether it's Blade Runner or other science fiction movies out there, there's a lot of cool stuff, and I'm a big sci-fi fan ever since I was a little kid. And I remember telling people when we went from 1G to 2G to 3G to 4G to 5G, just keep watching Star Trek, just keep watching Star Wars. They're already telling you where we're going to be someday. We're going to get there. We're trying to get there. So stocks take pressure on uncertainty. Stocks take pressure when your growth rate deteriorates. One final comment there. Cable companies, are fighting a battle, right? Cable companies were dismissive of fixed wireless. They're not dismissive anymore. Fixed wireless has been eroding into that, and cable companies have been seeing their broadband subscriptions under pressure because of fiber overbuilders, because of fixed wireless, because of satellite coming as well. So you don't want to go what's called X growth. You want to say, do I still have a growth prospect here? And that will get me a better value.
So take me through the media side of the equation, or maybe broadcasting, I guess, which does that have a growth story? And are there sectors where the economy and the market require the deliverables that aren't to be there, even though the consumer side of the equation is beneficial? I think of something like newspapers. The business for newspapers is terrible, but the takeaway from consumers is incredibly high. So it's kind of, and the market won't sustain existing newspapers. They've changed the business model, whatever the case may be, hasn't exactly worked. But is the market too tough on broadcasting and maybe newspapers? Is it unsustainable?
Yeah, so a lot in there. A lot. We'll unpack that.
Yeah.
When you consider how do newspapers or broadcasters make their money? Advertising, right? Used to be also subscription. More and more people are subscribing to streaming services. So cable's come under a lot of pressure. People are cutting the cord. But now you're starting to get so many streaming services, you're like, wait, am I paying more now with what I get versus what I used to get? So you have to look at the root revenues of what's happening, right? And say, who's getting share? I think you and I have chatted about it too. You had universal service, you had high income areas that would say, we're supportive of trying to get broadband and communications into high cost areas and rural areas. All of a sudden, YouTube was getting a lot of advertising. TikTok getting a lot of advertising. Streamers trying to get more advertising. Now you see Amazon Prime, Hulu. The streamers are starting to say, hey, if I put an ad tier in instead of just a premium ad free, there's people that are willing to pay to receive some ads, even in their streaming service. So you look at that balancing of where's the revenue at, who's getting the slice of the pie, and right or wrong, a lot more is going from your phone than your TV, and say, how do you play in that? And so the smarter companies in the media world have had a streaming strategy. Brent Pencher, who works with me and is going to be moving up as I get ready to retire, Frank Laufman on the team as well. We did a report several years ago, probably 2.5 years ago now, saying HBO Max, Paramount, Peacock, 2 of the 3 need to merge. You have to somehow come together. You're subscale. We know in this industry, everything's about scale. It's so important to achieve scale. And that can help you become more efficient on your cost side to say how much EBITDA and free cash flow am I able to produce. So we looked at that and said 2 of these 3 really need to get together because you're fighting against YouTube TV, you're fighting against TikTok, you really are fighting against Netflix, but not just Netflix. There's a lot of other demand on where your eyeballs are at any given time. And that's what advertisers are paying for is eyeballs, the right eyeballs, and targeted advertising. So as we look at it, it makes sense for the broadcasters to say, can we merge? So you have the Paramount Warner Brothers deal. We heard, I think it was just today, or maybe it was last night, that all regulatory approvals have been achieved, but we're caught in a lawsuit, right? The Writers Guild is suing, but more importantly, 12 attorneys general are filing a suit. Interesting to us that the current governor of California and the Democratic nominee to be governor in the state of California have said, we think you should settle this lawsuit. This is not really good for the industry to fight through this lawsuit. So you look at that, and part of that combination is to create synergies, to create scale. Why did Aerial, OmniPoint, PowerTel, VoiceStream merge together? We started this conversation with. You were subscale. You needed to fight nationally, and you created T-Mobile, a great company that became a great stock for a long period of time. Probably will be again as they see where they want to be in the future. So scale is important. Understanding where the dollars are at is important. And then finding a way of how do you monetize it. Again, just a little side commercial. I really hope, hey carriers, I really hope maybe you do a better job monetizing 6G and hopefully in the future 5G because you've spent a lot of money on spectrum, you've spent a lot of money on CapEx, but to be blunt, Netflix probably made more money, Uber, Lyft probably made more money, Apple definitely made more money, that there's other industries that have made a lot of money on the backs of everything that the telecom world has really tried to help build and support. There's a highway out there. Somebody's got to pay the freight on the highway. So back to media. For broadcasters, for newspapers, you just have to understand where the future is at. We cover Versant as well. Versant has MSNBC, okay, MS Now, and they have CNBC. They have the Golf Channel. They're really leaning into, can we get more digital? Can we get more of the growth aspect? We got two great brands. People that I deal with, CNBC's on the background all day long. So you've got some really strong brands that have affinity. I'll throw one other final one in here too, sports. Sports are key. Live sporting events, we saw it with the World Cup, right? The World Cup was an exciting thing. Coming to the Americas was really exciting. We showed well with Mexico, Canada, and us. Hopefully that will help tourism in the future as well. But sports is key.
You sort of got to this earlier question, but I'm interested in your take on I'll call him the hottest disruptor out there, Elon Musk. What do you, when you look at all that's been said recently about where he may take his business model, where do you see what are you reading in the tea leaves? Where do you think this is going? Is he really going to make a play for terrestrial wireless offering in one form or another?
Sure. It's a great question because it has been the topic of the summer, and for a while we had to just refer to it as Voldemort because we weren't able to say the name. But the concept to us is, what's your end game? My belief is, I really do believe Musk wants to get to Mars. Wants to be an interplanetary species. Moon is a jumping off block to get there. So I think, if I think about what do I think motivates him, and I have never met him, full disclosure, but I say what I read and understand and the vision I have of a visionary guy is he wants to place humans outside of just Earth. And what does it take to get there? Well, you need rocket ships. Okay, what am I going to do with these rocket ships? Well, and it's really as an engineering marvel to see them catch as it comes back down, catch that and land it. That is, as an engineer, hats off. That is amazing. Great job. You got to get up to the next level, right? Starship. So can we create a heavier one? You look at this and I'm like, I don't know that mobility is the end game. The end game is Mars. Intermediate game is the moon. How do I get you there? And we're going to be talking here at the Park City Summer Summit. Appreciate you coming. There's going to be a lot of topics of satellite impact on wireless, satellite impact on broadband, satellite impact on data centers, satellite impact on towers. It's all over the place in our whole space where there's a lot of questions on satellite. To me, I would say go back to physics, go back to what you can or can't do. I also remember a Park City Summit not too many years ago where Sprint was talking about they had a secret sauce. They had something that was going to change the world of wireless in the United States. And that, it had worked great in Japan. And I'm probably misquoting, but it might have been John Ledger, who was a great maverick in the space. I think Ledger might have been the one. I might be wrong, so don't quote me on who said it. But somebody said, you know what, you can put Japan inside the state of California. That to solve the United States, you need something more. And towers are probably a large way of how you supply the vastness of the United States. So as I look at it, I think the pie is expanding. I don't think you're trying to become a new EchoStar, Dish, Boost Mobile and say, how do I get from 7, 8, 9 million subs to where the other guys have over 100? Like how do I become scaled? It's going to be hard to be scaled as a cellular operator. And you look at it and you say, what about drones? What about autonomous vehicle? What about robotics? Humanoid robotics. There's a lot more stuff that seems to me that fit with the Elon Musk vision of where he's trying to take humanity as opposed to just direct to cell. That's why direct to device might be more so. But you can't, in my opinion, fairly educated opinion, but an opinion, you can't compete from space alone. If you want to be mobile, wireless, or fixed wireless, you're going to need terrestrial aspect, terrestrial spectrum, terrestrial network. Also, I don't believe small cells or femtocells is a solution for the vastness of the United States either. I think every spot has its every technology has its location. Fiber works great, dense urban, urban starts falling apart, suburban, rural. Even if you give us nice subsidies out of the US government, it falls apart eventually. I don't have enough money to support putting fiber everywhere. Fixed wireless can go deeper. Satellite can go deeper. So there's the right technology for the right spot. And I think right now there's a lot of confusion, maybe deliberately caused confusion to create the fog of war, to kind of say, maybe it's not totally clear what's happening here. We say, go back to the laws of physics, go back to what do you think the end game is, and I think it was Stanky who said, hey, we're a pretty mature industry, we're doing a pretty good job on what we've built here. So again, how do you come in, why does somebody choose to leave you? Why does somebody choose to leave AT&T, Verizon, or T-Mobile to go to some other operator? T-Mobile, years, talked about the pain points. How do I fix pain points? We're trying to fix more pain points, so I'm not sure that Musk really wants to execute to have a high margin, very high margin, wireless mobility service as opposed to, is it something else?
I'm intrigued on your thoughts on how important the regulatory process is for your analysis, whether it be FCC, FTC, state PUCs, maybe it's congressional action, administration and its but becoming more aggressive and engaged in the issues. How do you see that influencing your work and then also the industry?
Yeah, so at the Park City's 21st year of the Park City Summer Summit, DLJ was one of the people I thought highly of as I left the industry to come out here. Allen and Company does the Sun Valley Conference. They were one of the thoughts in the back of my mind when I created the Deer Valley, Park City Summer Summit and Winter Summits of let's go somewhere out of New York where we can all have conversations about the future of our industry. And as you know, Mike, we have regulatory panels here both mornings, policy and regulatory, because particularly an industry like telecom, media, even technology, the TMTs that I look at, tower guys as well, look at it. There's aspects of regulatory that affects the industries I follow that can make it better or easier, that can remove barriers, that can approve mergers that are needed to create scale. So the regulatory environment, whether it's political, regulatory, the DC environment, let's call it, is really important. And that's why spectrum, we talked about that earlier. I mean, we really appreciate what you did in your tenure at the FCC to get more spectrum out there, because spectrum is the lifeblood of wireless. So to get more spectrum out there is key. We need Washington for that. To be blunt, we were disappointed that the FCC lost that ability for a fairly long period of time. Glad to have it back. Glad to see Chairman Carr moving forward. Glad to see the One Big Beautiful Bill put it as a priority as well out there, because we talked about with 5G, this is a global battle. It isn't just between AT&T, Verizon, T-Mobile, or now SpaceX. It's a global battle to see who's going to create the economies, who's going to create the next big engines out there. So regulatory DC is really important. Now, I don't want DC picking winners or losers. And I think most people, when they look at Washington, agree with that basic tenet of we're trying to create a fair, equitable, known place where we know what the rules are. Tell us what the rules are and we can execute. But favoritism is temporary, and favoritism is hard to judge, and favoritism is hard for Wall Street to really understand how to invest in.
So does a non-traditional administration that may have those attributes, that makes your job not only harder but also harder for companies to get the equity they need to actually, to the point earlier you made, growth?
Yeah. I mean, and uncertainty. Uncertainty is bad. On Wall Street, uncertainty equals bad. And a Washington environment where you're like, and I can remember years ago, we were here at the St. Regis also, Obama had come in and we saw the pendulum swing from a regulatory standpoint. It used to be regulatory would kind of be, whether it was Democrat or Republican, it kind of went in this area on a clock. And then we started swinging wider and wider on the changes of who the administration was. And that's really hard for an industry that's capital intensive to work through, because is this going to change vehemently in 2 years? So that's where the more stability, rational, game playing is important.
When you look out into the future, you'll be somewhere else doing some fun things. I'm not doing this role per se, but when you look out, do you think that the telecom space has room and the runway to grow? And I take telecom in a broad sense. Communications, I guess, would be a better term. Well, does the certain sectors have growth? Wireless is tower. Do all the sectors have room to grow, or do you see it more as an M&A play, and we're going to see constriction and maybe some conversions going forward, and finally get the convergence moment that everyone's been talking about for a decade, where some company owns a little bit of everything. They can do a little of everything.
Sure. And when we think about SpaceX and Elon Musk, one of the common phrases, beside optionality, is vertical integration. That's one of the key messages of what they think they can do well, take control of the whole process. I get a little concerned if people get too vertically integrated. I mentioned earlier on the tower stocks that the birth, the boom, the bust, but then the rebirth. Don't overpay, don't overlever. The third thing was stick to your core business. And one of the tower companies started getting into owning the steel bolts and clamps that were holding equipment on the towers. That's vertical integration to the extreme. Plus, what am I going to value a commodity business like steel clamps at? And so you have to be careful, how much vertically integrated are you? How much intellectual property, how much growth is there? What are you really improving by vertically integrating everything if you try and do that? But I do think change is a given, has been since I first started in this industry back in 1979. Change is a given. So how do you manage change? How do you lay out a plan? Where am I going to be? Where's the industry going to be? What's my position in that industry? Apple, I don't think people really understood Apple. We're on to the iPhone 18 pretty soon. That was a sea change, right? That really shook things up. But it sent a lot of money over to the handset guy instead of the wireless world. And so we have to understand, what are our strengths, what are our weaknesses, what can we do, and how do you extract value out of what you're building? It's networks, right? Whether it's wireless networks, wired networks, satellite networks. This is network engineering. Power networks, broadcast networks. Networks are very inherent in what we do. So how do you position your network into the future of what your value proposition is going to be to get your share of that growth? So I'm excited. 1G was voice, 2G was texting, 3G was data, 4G was video, 5G's been fixed wireless so far. We hope for more. 6G also hopes for more. I'm excited by the science fiction potential of what could make life better for people, and telecom, media, tech can all help do that. How do you fight to get your share is going to be the important thing.
When you look back since 1979 or maybe 96 when you joined Raymond James, 30 years career there, what are you going to miss the most? Did you walk away?
The people. The people are great. It's been so fun to get to know you over the years. I look back on all the people I've met and the connections I have. Smart people. I mean, we've got some really smart people that have focused their energies into this area. I think who are genuinely excited about trying to improve people's lives by saying, the human race has been nomadic, right? We have certain aspects where you develop agriculture, but as a species, we're pretty nomadic. And so I really loved it when wireless came in, because that meant you didn't have to go to the payphone. You didn't have to go to the long extension cord in the kitchen. Helping people live what our species really thrives on is good. So I'm going to miss the people. I'm going to miss the excitement, because clearly, there's a lot going on. Any given day, you're going to wake up and find, wow, we better make sure we understand what's going on with that. So the people and the excitement, but I'll be watching. Like I said, don't be surprised if I don't show up somewhere. I just don't want to have to do 120 more earnings calls, and the grueling nature, the clock is you have to be. I tell the people that come to work for me, it's like what we do is we make a product. It's a labor-intensive product. You give it away for free. It goes stale really fast. How do you make money doing that? Relationships. You make it by being honorable. You make it by being open and communicative and trying to say, let's all get smarter here. So the business I'm in requires relationships. So what I'm going to miss the most is those relationships, but I don't think they're going to be gone.
Well, I appreciate your openness with us. Rick Prentiss, it's been a pleasure. Thanks so very much for your
time. You bet, guys. Take care. Everyone, enjoy.